Hey, welcome back to another weekly market outlook. This is for the 13th to the 17th of March 2023. So there's a lot to cover this week. So let me just go briefly on what's going on last week. There's a few discussions to talk about. So from last week, I think the key events would be the J. Powell testimony and what he's saying. It's basically the Fed is actually willing to return to a faster pace of interest rate hike if necessary, right? Depending on the upcoming data, obviously. But the surprise number last week was obviously the employment number, which was going to be the focus, and this is after the testimony. We have the NFP numbers, which is printing up about 300,000, which is great. That's a great surprise to the upside. However, the unemployment rate that got bumped up as well from 3.4% to 3.6%. And then we have the Bank of Japan, Governor Kuroda's last monetary policy meeting. Nothing has changed. That kind of gave a little bit of a sell-off in the Japanese yen. But I think what we need to discuss it's the flip-flop that's been going on with how the Fed and how the market is reacting to what the Fed is saying. So basically, what we have from last week after J. Powell testimony to the Banking and Housing Committee is that the expectation for the interest rate hike went up from 25 basis points to 75 basis points, and this is a huge jump. It was from a 30% consensus of a 50 basis points hike to 70% consensus of a potential 50 basis points hike. And then the bad employment numbers happen midweek. We have we've got Silvergate already going on, and then we have the SVB, or the Silicon Valley Bank, closing up, basically failing on Friday. So and then we have an urgent announcement, which I'm going to read through the joint statement from the FOMC and the FDIC, as well as the US Treasury as well. So there was another bank, which is Signature Bank in New York, that was actually closed down by the regulators to prevent any fallouts or any contagion, and that happened on Sunday, which is over the weekend. So a lot of things happen, and this is where it gets a little bit interesting. It does flip-flop things a little bit because J. Powell testimony, people are expecting a 50 basis points hike. The employment numbers happen, people are expecting 25 basis points hike, and then there's this fallout with all these three banks, and then all of a sudden everyone is just saying, hey, you know what, it's all FOMC's fault for hiking interest rate and causing a lot of the pain that's been going on. It might ripple out of out of control. We're not sure what's likely going to happen. However, from what I can tell, comparing it to what happened in 2008, which was there, right? 2008 to where it is right now, we are looking at a very different scenario compared to Lehman Brothers and the SVB. SVB's business, it's pretty much catered more towards startups. It's not a small bank to a certain degree. Signature is also not that small of a bank, so there are smaller banks out there. So the impact from the SVB and the Signature over the weekend, that might impact smaller regional banks, right? So, but that's what's going on with the market, and it does cause a little bit of a flip-flop in terms of basically figuring out what the FOMC is going to be doing. So that's basically just a recap of what happened last week. In terms of this week, we already have that Fed announcement that came in early Monday morning in Asia. That came in pretty much Sunday evening in the US. For Tuesday, we've got the UK claimant count change, and then obviously the key data for this week is actually the CPI numbers. We're looking at a CPI number. We're looking at the headline CPI number expected to drop from 6.4% to 6%. The forecast for this one is actually 6.0% to 6.1%. So if we get a number at 6.3%, that's actually still good. We're not looking at that much of a slowdown in inflation, and it goes back to the argument whether or not the FOMC needs to stop hiking interest rate because of what's going on with the bank. I don't think the FOMC is tied up or really concerned about what's going on right now. It might give back a little bit of a confidence in the market, but I think the FOMC needs to do what they need to do is the main goal would be price stability, and they need to control the inflation. So if we have the inflation number coming in at 6.3%, that might give the consideration that the FOMC needs to continue to hike rate even by just 25 basis points. If we have an increase in the headline CPI, let's say we have a number at 6.5% or 6.7%, then the FOMC actually needs to go with that 50 basis points interest rate hike. So we are looking at separate scenarios. However, the market mentality and the sentiment, it is a little bit funny at this point in time, right? The core CPI expected to remain flat. It's like the core CPI headline. Core CPI is actually expected to drop down a little bit from 5.6% to potentially 5.4%. But we'll see what happens with the core CPI. If the core CPI does climb back up again, or it remains stable at 5.6%, then we're still looking at the potential market flip-flopping again, thinking that the FOMC needs to continue with the rate hike. All right, and then on Wednesday we have the UK annual budget release. If you're trading in sterling, you need to pay close attention to that one there, because we know what happened with the previous budget release that happened in October and November. It created a little bit of a crash in the sterling, so we need to pay close attention to this one here. On Wednesday as well, we've got the US PPI numbers. So we got CPI on Tuesday. Wednesday we've got the PPI, again CPI consumer. PPI would be the producer price index, as well as the retail sales coming out from the US on Wednesday. On Thursday we've got the Australian employment numbers, and the main event would be the ECB interest rate decision. They are expected, it's pretty much confirmed that they are actually going to hike by 50 basis points. So it's going to be from 3% to 3.5%. What we need to know is from the press conference whether or not Lagarde is actually going to mention what's coming on in May. They're going to go with that 50 basis points again, because that was basically what they were saying in the previous meeting. Whether or not they're actually going to follow through and confirm there's actually going to be a 50 basis points hike in May from the ECB. Other than that, we've got preliminary UOM Michigan consumer sentiment on Friday. That pretty much wraps it up for the week in terms of the fundamentals. All right, so let me read through the joint announcement, Treasury, FOMC, and the FIDC. This is just a quick reset, excerpt of what they were saying. So taking decisive actions to protect the U.S. economy by strengthening public confidence in our banking system. Both of the FDIC and the Federal Reserve, and consulting with the President, Secretary Yellen, approves actions enabling the FDIC to complete its resolution of Silicon Valley Bank. No losses associated with the resolution of Silicon Valley Bank will be borne by the taxpayer. All right, it's all coming out from the Federal Reserve. We're also announcing a similar systemic risk exception for Signature Bank New York, which was closed today on Sunday by its state's chartering authority. All depositors of this institution, SVB, will be made whole. Signature shareholders and certain unsecured debt holders will not be protected. Signature senior management has been removed. The Federal Reserve Board on Sunday announced it will make available additional funding to eligible depository institutions to help assure banks have the ability to meet the needs of all their depositors. Banking system remains resilient and on a solid foundation. Any Signature Bank losses to the Deposit Insurance Fund to support uninsured depositors will be recovered by a special assessment on banks. Fed will make available additional funding to eligible depository institutions to help assure banks can meet depositors' needs. To provide liquidity to U.S. depository institutions, each Federal Reserve Bank would make advances to eligible borrowers, taking as collateral certain types of security. Treasury Department using the Exchange Stabilization Fund would provide 25 billion as a credit protection to the Federal Reserve Banks in connection with the bank's term funding program. Today's action demonstrates U.S. commitment to take necessary steps to ensure that depositors' savings remain safe. Eligible collateral includes any collateral eligible for purchase by the Federal Reserve Banks in open market operations. Rate for term advances will be the 1-year overnight index swap rate plus 10 basis points. This rate will be fixed for the term of the advance and on the day of the advance as made. Collateral valuation will be par value. Margin will be 100% of par value. Advances can be requested under the program until at least March 11, 2024. Advances made under the program are made with recourse beyond the pledged collateral to the eligible borrower. In short, it's technically not a bailout, but it's more like a mini bailout to a certain degree. In terms of the guarantee, I believe the guarantee from the FDIC in terms of the saving, it's up to 250,000. But that's pretty much it. That's basically what the FOMC Treasury and the FDIC is attempting to do to prevent any contagion, to prevent any fallout. Now, because this is still developing, we don't know how the domino effect is going to be around the world. How is it going to play out and impact all the other banks, and smaller banks in the US as well. But we're looking at a very different scenario compared to 2008, which takes the world by surprise. Stress test has been done throughout since 2008 up until now. So I believe the larger banks would be okay. Not quite sure with the smaller banks, but all this happens because of near 0% interest rate. It's all easy money, and all of a sudden when interest rate starts going up, banks are starting to fail. That's basically the gist of it. And the rumors going around is that the market does not want the FOMC to continue hiking rate. I think they need to take a pause to assess the situation, and I believe the FOMC is going to be assessing this situation very closely. We've got the meeting in terms of interest rate decision, which is going to be next week, so this is going to be included in the meeting, as well as the employment numbers and the CPI numbers that's going to be released tonight. But the overall sentiment in terms of on how we read the sentiment in the market, this is going to be again very tough, because we've got market flip-flopping around because of all the different datas and all the different sentiments weighing into the market at this point in time. All right, let's take a look at the technicals. The dollar index remains flat at this point in time. It's technically not a weak US dollar at all, because we do have that bounce from 104 traded within 104 105 up to 106 range. This one here is still intact, so it's too early to tell that the US dollar would be weakening because of all the current situation. At this point in time, the dollar index doesn't reflect that at all. Now, if we take a look at the 10-year yield, we have that huge drop because of the whole SVB and the signature bank issues. So the bond market is taking a real hit right now. But if there's actually a silver lining to this. We take a look at the 10-year yield. The drop was significant. The 2-year yield was even faster. So what it does is the spread between the 10-year and 2-year yield gets smaller, and this is basically reversing the inverted yield on the 10-year yields and versus the 2-year yield, which is a good sign that we're not really into a recession, because if the 2-year yield drops quickly faster than the 10-year yield, then I think that's actually a much better scenario for going forward into the future. So this is very interesting. But this reflects the short-term strength of the US dollar as well. Now, if we take a look at the Aussie USD, this one here recovered a little bit, but this one here, it is range bound. We've got that pivot at 66 cents. In terms of resistance, we've got 67 cents. There is a little bit of gap on Monday, so I think that gap might need to be filled as well, but I'm not seeing it at this point in time. Especially if Aussie USD managed to break above 67, then I don't think the gap needs to be filled immediately. Eventually it will be filled, but so just keep that in mind, that there's actually that gap around 66 cents on the Aussie USD. 67 cents, that's a resistance beyond 67. We've got 67.50. In terms of support, immediate support at 66 cents. Below 66, we've got 65 cents for the Aussie USD. Euro USD, need to keep in mind over the hidden bullish divergence that was mentioned since about 2 weeks ago, it's still valid, and the only time it will become invalidated would be when price touches 1.05. So we don't actually have price touching 1.05, and this one here has recovered a little bit faster, a little bit higher. In terms of how far up the Euro USD could go, again, remember that the ECB is taking a little bit more of a hawkish stance. That could really boost the Euro USD a little bit higher. So we've got 1.0750. This is where the currently price is traded right now. That's going to be the immediate resistance. In terms of how far up it can go, there's a potential for this one to return towards 1.08, 1.0850. In terms of support to the downside, we've got several supports to the downside: 1.0660, 1.06, and ultimately 1.05. A break below 1.05 would confirm a potential reversal on the Euro USD. And for now, if the cap is at 1.0750, there's a potential for this one to actually form a head and shoulder chart pattern, so we need to keep that in mind. A head and shoulder pattern is actually still potentially in play, unless we see that break above 1.08, then it will actually invalidate the head and shoulder. So we'll see with the Euro USD. Pound USD, this one here, position traders are going to have a hard time, because this one here transition back to 1.2, and overnight, this one here early in the morning, we have a break below 1.2150. Now that break above 1.2150 actually takes this above the Ichimoku cloud again, so there's a little bit of a really choppy market condition going on. In terms of the pivot is actually located at around 1.1980, so that's very close to 1.2. Price is currently above resistance 1. This one here could actually find a little bit of a resistance at 1.23 if it continues to get pushed higher. Especially if the UK budget comes out really good, we might actually see a push towards 1.23 for the pound USD this week. So we're looking at the weekly pivots here. I think we are way off from the current support, so we might actually see a potential move towards that 1.23, which is resistance 2 on the weekly pivot as well. Now with the dollar Japanese yen, this one here, pressure on the dollar. Obviously we're looking at that pressure on the dollar. We are looking at a little bit of a run towards safe haven to the Japanese yen. So the impact on the dollar Japanese yen is right now we do see that drop currently below than 133.50. In terms of support right now, we have support at 132, and that's pretty much it. That's support 2 on the weekly for the dollar Japanese yen. Extended break below 132, then we might actually see a return towards 130 for the dollar Japanese yen. Any pullback to the upside is likely going to be limited at around 135.50, which is basically roughly where the weekly pivot is located for the dollar Japanese yen. All right. Then we have the Bitcoin USD. Taking a look at Bitcoin USD, obviously we have issues with the banking system, and everyone is just pretty much running back to crypto. So this one here instead gain that extra bit of boost right now. In terms of how far it can go, this one here is already at resistance too. In terms of the pivot, that is located at 22,000, so we do see that strong recovery on Bitcoin right now, just on the back of the all the bad news regarding the banking systems and stuff like that. So I think that probably drives a little bit of sentiment that crypto could be a better option. I'm not into that kind of thought, but this is basically what I think the market is looking at. In terms of how far it can go, can it go to 25,000? There's a potential for this one to go up to 25,000, but in terms of whether or not it can break 25,000, again, that will really depend on how bad the situation is in terms of the banking system. If it gets worse, then yes, I think a lot more people are actually going to pour in their money into Bitcoin, and that's likely going to drive it a little bit higher. All right. Lastly, we've got gold. With gold, the story going around that the FOMC is going to be stopping interest rate hike. This one here has pushed gold beyond 1900. There's a little bit of resistance about 1925, but this one has exceeded 1900. Now again, this could change if the inflation number comes up really high, where the market would then expect the FOMC needs to hike interest rate. If there are no further development in terms of any fallouts from any other banks, then the FOMC will decide that it's really more of an isolated case, and they're doing their reviews right now, and they'll probably announce that review during the monetary policy announcement. But if the CPI number comes in a little bit hotter, then we might actually see this one pull back towards 1880 to about 1900 for gold. All right, so that's a lot to cover this week. So yeah, take it in, flip-flop on the sentiments, a couple of warnings here and there. At this point in time, we do not know if there's actually going to be any spillover, any contagion, any domino effects into the financial market as a global, on a global scale. So we'll see what happens there. Any further developments will be updated as soon as I can. All right, good luck with the trades, and I'll see you soon.